Now let's discuss the fourth chapter of Economic Survey, Volume 2 for the year 2019 and 2020. This particular chapter is basically a concept of monetary management as well as financial intermediation. First and foremost, the Economic Survey makes a note of what policy changes have been introduced or what monetary policy changes have been done in the last 1 year by the central banker. Out of the 5 monetary policy committee reviews that were conducted, in 4 of them, RBI decided to cut the lending rates. That is basically they reduced the repo rate. But in the 5th monetary policy committee review meeting, the committee decided to hold the lending rates. Not only this, during this particular period, the survey also notes that the stance of the monetary policy committee has changed from the neutral to accommodative. Now, please understand, first and foremost, cut in the lending rates. You can see that the repo rate has been reduced as well as the statutory liquidity ratio also has been reduced. Repo rate in simple terms is nothing but the rate of interest that is charged on the short-term loans that are given by the central banker to the banking institutions. So this particular reduction in the lending rate in the form of a cut in the repo rate is done in order to ensure that more credit is issued by the banking sector at lesser rate of interest in the market, which basically leads to the concept of a virtuous cycle of a growth. Apart from that, RBI also has reduced the statutory liquidity ratio, which is a percentage or proportion of the NDTL, net demand and time liabilities, that the banks will have to maintain either in the form of a cash, in the form of a gold, or in the form of a G securities. So this also has been reduced, and the objective is to basically ensure again that the capital or the credit availability in the market will increase. So RBI has taken these particular measures in order to increase the capital availability or money availability in the market. Apart from this, there is also a change in the stance from the neutral to accommodative. Please understand, monetary policy stances are of 3 types. One is accommodative, second one is neutral, and the third one is calibrated tightening. The basic difference between all the 3 is this. In case of the Monetary Policy Review Committee, they are trying to indicate to the market what kind of a policy decision could be taken in the upcoming or the next monetary policy review. That is, when the committee says the stance is neutral, it basically means the committee is not going to tell whether they are going to increase or decrease the lending rates. And when they say calibrated tightening, they are basically going to say that, or they are indicating that they are not going to cut down the lending rates. And on the other side, accommodative basically means there could be change in the lending rates where the central banker could cut the lending rates in the coming or in the next monetary policy review. So these are the 3 stances which are usually used by the central banker. But in this context, what you need to understand simply is this. The central banker has changed the stance from neutral to accommodative, which means in the coming days, the central banker may decide to cut down their lending rates again. Now, this is one very important point which has been mentioned. Apart from this, RBI in its recent report has revised the GDP growth rate for the Indian economy for the current fiscal. This particular revision has been done downwards. That is, basically RBI has estimated that the GDP growth rate for Indian economy for the current fiscal will be around 5%. With respect to liquidity management, in the recent times, certain tools have been used by the central banker in order to infuse liquidity in the market. The 3 tools which have been mentioned in the economic survey are: 1, open market operations, second one is operation twist, third one is reduction in the SLR. Please understand, under the concept of OMO, open market operation, which is nothing but a conventional monetary policy tool, RBI will either sell G securities or purchase G securities from the market. Whenever RBI sells G securities, it simply means it is basically sucking out the liquidity from the market. And whenever RBI purchases the G securities, it is basically infusing liquidity in the market. So as per the changing situation, that is, whenever there is a need to promote growth, RBI can go for repurchasing of G securities, and whenever RBI wants to control inflation, it can go for selling of G securities. So in the present context, all of us know that there is a need to revive GDP growth rate. And one of the ways of this particular revival that can be done is by infusing liquidity in the market by conducting open market operation, wherein RBI will be purchasing the G securities and infusing liquidity in the market. So this is one tool which has been used by RBI or the central banker to infuse liquidity. Second, RBI also has conducted Operation Twist. This particular term, Operation Twist, has been basically borrowed from the Federal Reserve operations, where they basically conducted the same concept. But in case of India, RBI basically purchased the long-term securities and sold short-term securities in the market, thereby ensuring that the yields for both of them will be adjusted in the market, and the banking sector, who have heavily invested in the long-term securities, will be getting lesser yields. Hence, they will not be investing in these particular long-term securities. Rather, they will be investing in the market by lending or by issuing more and more loans in the market. That is the basic outcome that is expected from the Operation Twist. Third one, reduction in SLR. Please understand, as already mentioned, SLR stands for Statutory Liquidity Ratio. In case of SLR, the banks will have to maintain certain part of their net demand and time liabilities in either the form of a cash, or in the form of a G securities, or in the form of gold. Although the banks have got three options, majority of the banks basically maintain huge amount of their NDTL in the form of G securities. As per various RBI surveys itself, it has been seen that though the SLR is below 20%, majority of the banks maintain more than 20% of their NDTL in the form of G securities. This has been done in order to ensure that the banks will not be taking higher risk by issuing loans in the market. The risk associated with investing in G security is very, very less, because these are guaranteed by Government of India. But the problem with respect to this particular practice is, when banks keep huge amount of their NDTL in the form of G securities, their lending in the market will be lesser. But in case of RBI, they have reduced their lending rates, that is repo rate as well as SLR, in order to ensure that the credit offtake will increase. So the reduction in the SLR also has been done by RBI in order to ensure credit availability in the market will increase. So these are the three very important tools which have been used by RBI in the recent times to manage the liquidity in the market. Now let's have a look at certain points related to banking sector. The survey notes that gross non-performing assets, which are nothing but the loans or advances which have been issued by the banking sector, in which they are not earning any kind of an interest. And since they have not been able to get any kind of a return payment in case of these particular assets for a period of, let's say, 90 days, these particular assets are being classified as a non-performing assets. So as per economic survey, the gross non-performing assets have stayed flat at 9.3% of the gross advances at the end of the September 2019. Next, CRAR, that is a capital to risk weighted assets ratio. Apart from using CRAR, it is also represented by the concept of a capital adequacy ratio. Capital adequacy ratio, or CRAR, of scheduled commercial banks has increased. Please understand, every bank has to maintain certain capital in order to ensure that the losses that are incurred by the banks are absorbed. The minimum capital that is supposed to be maintained by the banks is referred to as a capital adequacy ratio, or capital to risk weighted assets ratio. Now, why it is referred to as a capital to risk weighted assets ratio? Every bank will issue loans. These particular loans are issued to different types of borrowers in the market. These particular loans are, in simple terms, assets for the bank. Now, since these particular assets are issued, or these particular loans are issued to different type of borrowers in the market, these borrowers will carry certain risk. For example, if the bank gives a loan to real estate sector, the risk associated with this loan will be much higher. Bank gives a loan to industry, comparatively lesser. Bank gives a loan to Government of India, the lowest risk is associated. So these particular assets are given certain risk weightage. Hence, these particular assets are referred as risk weighted assets. Against risk weighted assets, how much capital has to be maintained is, in simple terms, called as a capital to risk weighted assets ratio, or capital adequacy ratio. The survey makes a note that the capital adequacy ratio, or capital to risk weighted assets ratio, of scheduled commercial banks has increased. And one of the very important reasons this has increased is because the public sector banks' capital adequacy ratio also has improved. Next, there is a problem with respect to monetary transmission. Now, what do you mean by monetary transmission? In simple terms, RBI gives loans to banks. Banks in turn will give loans to borrowers or customers in the market. Now, what we expect is, whenever RBI changes its lending rate, it will have a direct impact on the lending activity of the banking sector. That is, if RBI reduces its lending rate, we expect credit offtake in the market to increase. And when RBI increases its lending rate, we expect a credit offtake in the market to come down because it has got a direct linkage. So whenever the rates are changed by RBI, what is the impact of this particular rate change on the credit offtake or credit issued by the banking sector? Is it changing or not? Is referred to as a concept of a monetary policy transmission. In recent times, there has been certain problem with respect to monetary policy transmission, wherein we are saying that the transmission has been inefficient. That is, on one side, RBI is reducing its lending rates, but the offtake of credit is not increasing, which is basically reflected in the form of the credit offtake done by these particular banking sector to different types of borrowers in the market. The survey makes a note that this particular monetary policy transmission has been weaker because of three reasons. One, weighted average lending rate. That is, please understand this, the banks will borrow from RBI and will issue to the borrowers in the market. This particular monetary policy transmission in recent times has been very weak or very inefficient, which is reflected in the fact that RBI has reduced its lending rate by more than 100 basis points, whereas all the banks put together have not reduced their lending rate even by 50 basis points. So RBI has said that this is an inefficient monetary policy transmission, and survey makes three very important findings with respect to monetary policy transmission. One, the weighted average lending rate has not come down in case of Indian banking sector. The survey makes a note that all the public sector banks put together, the weighted average lending rates has remained at around 10.7%. So basically, in case of public sector banks, the weighted average lending rate on outstanding loans is at 10.4% for the month of October 2019. And on fresh loans or fresh rupee loans which have been issued, the weighted average lending rates has been reduced by 47 basis points, which basically indicates that the lending rates by the banking sector have not been reduced in coherence or in proportion to the lending rate reduction done by RBI. Because RBI in the last 1 year itself has reduced its lending rate by more than 100 basis points itself. Second, credit growth. As per economic survey, it has made a note that the credit growth year on year for the month of April was more than 12%. And by the month of December, this particular credit growth rate had fallen down or slumped to 7%. Apart from this, the survey also makes a note that the credit offtake to industries or industrial credit growth rate has been very low in recent months. The credit offtake by the banking sector since the beginning of this particular year has been on a lower side. And the survey also notes that credit growth has been moderating since December 2018 in all the non-food sector loans except the personal loans. So in essence, the credit offtake or the growth rate of the loans which are issued by the banking sector have not been improving. Third one, the term structure. This basically discusses the yield rates in case of G securities. Please understand, yield rates are indirectly associated or indirectly correlated with the market prices of G securities. The survey makes a note that the yield rates on short-term G securities has declined at a much faster pace compared to the yield rates on the long-term G securities. And in fact, the economic survey notes that post-August 2019, the yield rates on long-term G securities has not declined by much. So because of these three issues, you can see that the monetary policy transmission has been very weaker in case of Indian banking sector. Apart from this, the survey also discusses certain points related to non-banking financial companies. The survey says that the sector grew rapidly in the financial year 18 and in the first half of financial 19. Since then, there has been a deceleration in the sector, and especially in the third quarter of financial year 19, it has witnessed liquidity stress. Now, why there has been a deceleration and liquidity stress in this particular sector? Please understand, two very big NBFCs, one IL&FS and second one is DHFL, defaulted on the repayment. As a result of this particular default by these particular credible NBFCs, there was certain issues with respect to liquidity of these particular NBFCs. That is, please understand this, NBFCs borrow from the banking sector and issue in the market or invest in the market. The problem has been the banking sector is very about the performance of the NBFCs. That is, what if they default in the coming days? Hence, the exposure of this particular banking sector to the NBFCs has been affected. Since this particular route to credit is under stress, the NBFCs are feeling liquidity stress. The survey also makes a note that there is an observable shift in the source of the funding of NBFCs. That is, no doubt, the borrowing of the NBFCs from the banking sector has increased. Because please understand, although I've mentioned in the earlier point that the banking sector is very about lending to NBFCs, it doesn't mean that the NBFCs are not getting access to credit from the banking sector. Many credible and bigger NBFCs are even today able to get access to credit, and this has been noted by the economic survey. Survey says that the access to banking credit for the NBFCs has increased. In fact, the survey makes a note that the access to credit has increased from 5.6 lakh crore rupees to 7.13 lakh crore rupees between October 2018 to October 2019. Having said so, the growth rate of this particular access to credit has been much slower in this particular period compared to the earlier period. This has been noted by the survey. Next, the deployment of mutual funds is decreasing since October 2018. Now, what is this particular point? Earlier, these particular NBFCs issued short-term instruments which are called as commercial papers. These are unsecured instruments which are issued by these kind of financial institutions. And these particular commercial papers were basically invested by these kind of mutual funds. But post the stress has originated, or post the default of IL&FS as well as a DHFL, there has been an observable sales of these kind of commercial papers at a huge discounted rate by these particular mutual funds. That is, in simple terms, these particular commercial papers which were purchased by the mutual funds, these are being sold in the market at a very heavy discount. And when these kind of sales of commercial papers at a discount are done by these kind of investors, you will see that the exposure of these kind of investors in these kind of NBFCs will come down. But beyond this, you must understand this. This might lead to a vicious cycle wherein the mutual funds will sell the commercial papers at a discount in the market. The market investors will get worried about the performance of such NBFC because the mutual fund is selling these particular instruments. So the investor sentiment towards these particular NBFCs or performance of NBFCs will become negative. This might again lead to problem to get access to credit in the market or raising money from the market. Next, NBFCs collectively maintained 19.5% CRAR at the end of March 2019. Please understand, NBFCs must maintain 15% in the form of a capital adequacy ratio, but collectively they are maintaining 19.5% at the end of March 2019. And lastly, the non-performing assets have increased from 5.8% at the end of March 2018 to 6.3% at the end of September 2019. These are some of the points which have been mentioned by economic survey in terms of the functioning of NBFCs. And last point, with relation to insolvency and bankruptcy code. Please understand, Government of India has implemented this particular code for over 3 years now. The objective of insolvency and bankruptcy code was to ensure that insolvency resolution will be provided for both corporates as well as retail borrowers who have defaulted on their repayment to the creditors. Under this particular concept of IBC, the survey makes a note that it has been over 3 years since the implementation, and this boasts of a strong ecosystem with IBBI, that is Insolvency Bankruptcy Board of India, as an adjudicating authority, 3 insolvency resolution professional agencies, and over 2,900 insolvency professionals. Apart from this, the debtors and creditors alike have initiated insolvency process in over 2,500 companies. Now, what is the meaning of this? Under the Insolvency and Bankruptcy Code, either the creditor or debtor can approach the respective authority to file a case against a borrower or to start insolvency proceedings. It simply means if X has borrowed from Y, either X can approach or Y can approach a respective authority to start insolvency proceedings. In case of the retail borrowers, the insolvency proceedings will be held by Debt Recovery Tribunal, and in case of a corporate borrowers, the insolvency proceedings will be held by National Company Law Tribunal. Now, apart from this, in case of a creditors, again there are 2 types of creditors, secured as well as unsecured. In case of insolvency and bankruptcy code, both secured as well as unsecured creditors can approach NCLT to file a case and to begin insolvency proceedings. As per a recent report which has been published by IBBI, close to 50% of the corporate cases which have been admitted under the NCLT or under the Insolvency and Bankruptcy Code are on the account of the cases which are filed by unsecured creditors or operational creditors themselves. Next, as of September 2019, about 743 of these particular cases have been completed, either resolution or liquidated. Having said so, please understand number of cases which are liquidated are very high. Having said so, please understand this particular point also. Not all these particular cases are new cases which have been filed. Majority of these particular cases which have undergone liquidation were basically the cases which were earlier under the Board of Industrial and Financial Reconstruction. And these particular cases, once the IBC was implemented, came under the concept of NCLT or were covered under the Insolvency and Bankruptcy Code. Hence, the number of liquidation cases are very high. And finally, so far the Insolvency and Bankruptcy Code has been amended 3 times. The latest amendment is the most important one. There is a very high probability that the latest amendment would be asked in the UPSC prelims or UPSC mains. For example, the latest amendment which has been done by Government of India is the most important. And there is very high probability that UPSC might ask a question on this either in the prelims or in the mains. The most important change that has been done by Government of India in case of the IBC is the time period has been changed from 270 days to 330 days. Earlier the time period was 180 days plus 90 days, a total of 270. Now the time period that has been given is 180 plus 90 plus 60. This extra 60 days has been accounted if there is a judicial interference, or in simple terms, the case is dragged to judiciary. If some creditor approaches a high court or any other form of a judiciary and files a case, this particular case has to be resolved within a time period of 60 days. Hence, the new time limit which has been provided by the government to resolve these particular cases has been 330 days. Next, apart from this, earlier the voting requirement in case of committee of creditors was around 2/3. Apart from this, another very important change that has been introduced by the government is in terms of voting requirement. As per the latest amendment, in case of committee of creditors, the voting requirement for passage of a resolution will be 50% of the present and voting creditors. So these are the 2 very important changes which have been introduced very recently by the Government of India in case of Insolvency and Bankruptcy Code. So these are the points which are discussed under this particular chapter of monetary management and financial intermediation.